couple of days ago, we got some February auto sales numbers that were not so hot, to say the least, with only General Motors doing really well out of the whole group. Now, maybe that's just because we've had some hideously cold weather that's kept people indoors when they might otherwise have been out car shopping. But we can't afford to totally dismiss the possibility that maybe something's truly amiss here. That's why tonight I want to check in with DealerTrak, TRAK for you home gamers, a company that provides car dealerships the most comprehensive suite of software solutions in the industry, including platforms for sales, finance, inventory, digital marketing, and retailing, as well as what are known as dealer management solutions, which is industry speak for total management system designed to improve a dealer's efficiency while giving them real-time analytics. On top of that, DealerTrak operates a huge credit application lending network that helps finance 45% of all cars purchased here in the U.S., while also providing electronic vehicle registration, title, and lien services. Now, DealerTrak reported on Monday of last week, and although the company delivered in-line earnings and better-than-expected sales, which rose 88.2% year-over-year, a lot of investors were disappointed by the full-year earnings guidance for 2015, which management said is under pressure from integration costs related to a recent acquisition of Encadia. That's an international purveyor of software and car dealerships. In response, stocks got slammed, fell 8.7% the next day to $40 and change. Hasn't bounced since. Is this merely a short-term speed bump or something more serious? Let's take a closer look with Mark O'Neill, the chairman and CEO of DealerTrak Technologies, find out more about the company and the overall industry. Mr. O'Neill, welcome back to Mad Money.
Thank you, Jim. Nice to be back.
All right, Mark, first, I was talking to Phil LeBeau, who is our excellent auto industry reporter, and February was punk. It just wasn't that good. And are you seeing this as being a blip? Are you actually seeing it happen, and maybe the numbers don't reflect it? And is it something we should worry about?
Let me start with, no, it's nothing we should worry about. So we did an analysis of all 50 states. We looked at the 18 states that were impacted by weather and compared their volumes to the non-impacted states. And our conclusion was unequivocally, it's a weather-driven event. While the SAR came in at 16.2 million, we're hoping for 17 million. We think we recover that volume between March and April. And maybe if Boston doesn't get out of the 6-foot snowdrift, maybe their volume will go into May. But clearly, our analysis shows this is a blip.
All right, terrific. Now, Wells Fargo, a bank I really like, recently tried to pull back from subprime lending. You are involved and see so much of auto lending. Is this something that could slow down sales in 2015?
We don't see it. In fact, if you dig deep into what Wells Fargo really said is they're going to cap the amount of subprime lending they do. And if you look at that cap relative to the volumes they're doing right now, they're really quite in line. So it would only be if car sales grew materially beyond 17 million and subprime increased as a significant percent that we'd have any worry. But to put in that in context, on the DealerTrak network, there are over 1,600 lenders doing lending. So if one lender decides to not be as aggressive in a segment, I'll tell you, it's a very competitive market now. We would expect other lenders to jump right in there.
A lot of people write these articles which just say that this is the next ticking time bomb. Now, you're deeply involved with it. I personally think that the credit picture of the American consumer is so good, it's not a ticking time bomb. But I respect people who say there's a bubble. Is there indeed a bubble in auto lending?
Unequivocally, from DealerTrak's perspective, there is not a bubble in auto lending. There are more subprime loans out there today than there were 5 years ago, but that's because we're selling 4 or 5 million more cars. And oh, by the way, 35 to 40% of our population happens to have a credit rating that puts them in a subprime category. But we're selling more cars. If you look at the performance of the loan portfolios, they're performing terrifically. We just do not see the bubble that is being talked about in the periphery here.
Okay, now, you made the acquisition. It seemed to confuse people, but I think that if you want to get that next level of growth, you have to make that kind of acquisition. Is there something you would do over on the conference call or something? Because to me, somehow it got muddled. And yet, if you're going to have the growth that I want to see from DealerTrak, you need to make that acquisition.
Excellent point, Jim. So let me make a couple comments here. One is DealerTrak, its core business, is growing over 15% a year compound, and that's organic growth. Oh, by the way, last year we grew 26% organically. So now we're a larger company, larger base. We continue to expect to grow significantly on an organic basis, as I said, 15% plus. As we look into 15, if I look at Encadia, there were 3 reasons we did that acquisition. One was long-term growth. Incaday will do $55 million in revenue this year, but by 2020, we think that business does between 200 and 250 million in US dollar revenue equivalent. If you put that into context, that's 100 to 200 basis points of growth that'll drive relative to the total DealerTrak revenue. So it gives us excellent long-term revenue growth. It strengthens our OEM relationships. There are only 2 companies globally where an OEM can do one-stop shopping for auto retail technology. We're one of those 2. And oh, by the way, this acquisition gives us the only platform that's in all 82 countries with a single technology platform, making us more nimble, faster to market than anyone else. And third, it gives us a platform to take some of our US software, particularly our digital marketing solutions, and bring those internationally. And while I don't think we'll do that in 2015, it certainly sets up us to do that in 2016 forward. And I think on the call, I don't think we conveyed the growth potential of this company. People got messed up with converting from IFRS to GAAP, and I think that was a lot of noise.
I totally agree with you because I like the acquisition. One last question. This Tesla model, I think Tesla's stalled, but when you say that, people get all over you and say it's not true. But the Tesla non-dealership model, is that something that if you looked 5 years in the future, more and more are going to go like that, or is that really just unto itself?
That's unto itself. In fact, I had the opportunities to listen to Elon Musk speak recently. He even suggested that their model in 3 to 5 years might include dealership distribution. You need the dealership for servicing the car. You really need it for touching and engaging with the consumer. We think it's a hybrid model going forward. There's a lot of online activity that happens, but also there's a very relevant position for the physical store to be part of the process.
Excellent. Well, Mark, I think you really straightened it out. I thought the acquisition was good. I don't know. I mean, sometimes you just get bargains because people don't get it. Mark O'Neill, Chairman, CEO of DealerTrak. Great to speak to you, sir.
Thanks, Jim. Nice speaking with you.
Stock's inexpensive, but I got to tell you what I felt great about is that he's confirmed the weather. He's done the actual work. So that blip down that I was worried about in autos, I feel much better about it after speaking to him. Mad Money's back after the break. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.